Has this thought ever crossed your mind? If I apply for a loan through Square, am I going to trash my credit score? It's a perfectly valid question, and one that echoes in the minds of countless small business owners, freelancers, and even individuals just looking for a bit of financial flexibility. We live in a world where credit scores feel like this mysterious, all-powerful entity dictating our financial futures. One wrong move and bam, years of careful building could seemingly crumble. So, when a convenient, seemingly accessible option like Square Loans pops up, it's only natural to wonder about its potential impact on that all-important three-digit number. However, this ease of access often comes with a subtle undercurrent of anxiety. We're constantly bombarded with advice about protecting our credit. Don't apply for too much credit at once. Beware of hard inquiries. Keep your credit utilization low. These warnings, while well-intentioned, can sometimes make the world of credit feel like a minefield. So, when faced with the prospect of applying for any kind of loan, especially from a non-traditional lender, the default setting for many is caution, often tinged with a dash of fear. So let's unpack this. Does applying for a loan on Square affect your credit score? The short answer, as with many things in the complex world of finance, is it depends. But don't worry, we're not going to leave it at that vague statement. We're going to dive deep into the mechanics of how Square Capital evaluates loan applications, the role of credit bureaus, and the different types of credit inquiries. By the end of this, you'll have a clear understanding of what happens behind the scenes and how to approach Square loans with confidence, or at least with informed caution. First, let's distinguish between the two primary ways a loan application can impact your credit: a soft inquiry and a hard inquiry. These terms are thrown around a lot, but understanding their fundamental difference is crucial. A soft inquiry, often called a soft pull, occurs when a lender or creditor checks your credit report for informational purposes. This could be for pre-approval offers, identity verification, or in some cases, for internal account reviews. Critically, a soft inquiry does not affect your credit score. It's like peeking at your own credit report. It doesn't leave a mark. When you check your credit score through services like Credit Karma or your bank's online portal, that's a soft inquiry. Lenders can also perform soft inquiries to see if you meet their general lending criteria without committing to a full loan application. A hard inquiry, or hard pull, is a different beast entirely. This happens when a lender checks your credit report because you have officially applied for new credit, a mortgage, a car loan, a credit card, or certain personal loans. A hard inquiry signifies that you are seeking new credit, and it can have a minor, temporary negative impact on your credit score. The impact is usually small, a few points, and typically fades after a few months. However, multiple hard inquiries in a short period can raise a red flag for lenders, suggesting you might be in financial distress or taking on too much debt, which can lead to a more significant drop in your score. Now, where does Square Capital fit into this? Historically, Square Capital has been known for its unique underwriting process, which relies heavily on your existing Square sales data. This means they look at your transaction history, your sales volume, your customer base, and your overall financial activity within the Square ecosystem. They want to see consistent, healthy sales, indicating your ability to repay a loan. This data-driven approach is one of the reasons why Square loans have been so accessible to businesses that might not have a long credit history or extensive collateral. For many years, Square Capital did not perform a hard credit inquiry when you applied for a loan. They primarily relied on their internal data. This was a huge selling point for small businesses and freelancers, as it meant they could potentially access funding without the worry of a hard pull impacting their personal or business credit score. This approach was particularly beneficial for those just starting out or those who had experienced past credit challenges but were now demonstrating strong business performance through Square. They were essentially using their own proprietary data as their primary credit assessment tool, circumventing the traditional credit bureau system. However, the landscape of lending is always evolving, and it's important to stay current. While Square's initial approach largely bypassed traditional credit checks, their policies can and do change. As of my last update, Square Capital may still primarily rely on your Square sales history and other internal data for initial loan offers and pre-approvals. This means that for some users, particularly those with a long and robust history of using Square for their business, the initial offer you receive might be based purely on your internal data, without a hard credit pull. This would align with the soft inquiry scenario, meaning no immediate impact on your credit score. But here's the crucial caveat. If your application progresses, or if Square needs more information to assess your creditworthiness, they can and may perform a hard credit inquiry. This is becoming increasingly common as financial institutions, even alternative lenders, integrate more traditional risk assessment methods into their processes. This means that while your initial engagement with Square Capital might be soft inquiry based, a full application could potentially trigger a hard inquiry. So, how do you know if a hard inquiry will be performed? The best way is to carefully read the terms and conditions presented to you during the loan application process. Before you finalize your application, Square is legally obligated to inform you if they will be performing a hard credit inquiry. Look for language that mentions checking your credit report or performing a hard credit pull from major credit bureaus like Experian, Equifax, or TransUnion. If you don't see this language, it's likely a soft inquiry or purely internal data analysis. If you do, then be prepared for a potential, albeit usually minor, impact on your credit score. Furthermore, it's not just the application that can affect your credit score. If you are approved for a Square loan and then fail to make timely payments, that will negatively impact your credit. While Square primarily uses its internal data to assess eligibility, they can and often do report payment performance to credit bureaus, especially if accounts become delinquent. Consistent on-time payments, on the other hand, can positively impact your credit score, demonstrating your reliability as a borrower. So, regardless of how the initial application affects your score, your repayment behavior will have a much more significant and lasting impact. The key takeaway is informed decision-making. Don't let fear of the unknown paralyze you. Instead, arm yourself with knowledge. Understand the different types of credit inquiries. Be aware of Square's current practices, which can evolve, and always prioritize responsible borrowing and timely repayment. Your credit score is a tool, not a fragile glass sculpture. Used wisely, it can help you build and grow, not hinder your progress. With that said, thanks for watching, and until next time.